And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, the whole enchilada. It's the Lance Roberts Show, presented by Clarity Financial. It's life, money, and sweat equity. Now, welcome in to the Lance Roberts Show.
And good Friday afternoon to you. I'm your host, Lance Roberts, and you're listening to the Lance Roberts Show podcast right here at realinvestmentadvice.com. Thanks for joining us today. A few things kind of going on right now as we kind of wrap up the markets. The markets are closing right now. The S&P's up just marginally, up about 0.8 points. NASDAQ's down about 6. Dow's up about 8. It was really kind of a pretty quiet day. Markets pretty much just kind of traded sideways most of the day. Kind of the big news of the day, of course, is really what sent the markets to the downside early this morning, which was news from the Trump administration that, well, he's looking to impose another $200 billion in tariffs on China. Of course, again, this whole trade war issue, as we've talked about over the last several days, markets don't like that. Now, I will tell you this, though. This is the interesting sideline of this, is that earlier this year when we had the sell-off in the markets, that was also tariff-driven. That was where these tariffs were first being announced, and we had a fairly big sell-off in just a couple of weeks. The market lost about 10% because of the threat of tariffs on future earnings and outlooks for companies. And of course, this whole ongoing diatribe about tariffs and what's going on with China and what's happening between the U.S. and all this. As you notice now, while we are still getting a negative impact from these announcements of tariffs, it really isn't much anymore. We get a few points to the downside, and then quickly the markets kind of absorb it, saying, we've heard this story before. Because as of yet, those tariffs really haven't worked their way through the system. See, we haven't been through an earnings period yet where we're starting to see the real impacts of tariffs. We've had a lot of talk about it. We've had a lot of conversations about tariffs, but we haven't seen the real impact to earnings. See, the risk to the markets from tariffs is going to be when it actually shows up in bottom line earnings. You know, right now, earnings estimates are still very elevated. We have an extremely high expectation for continued growth and quarterly earnings because of tax cuts. But again, when these tariffs show up, and if they do show up and start to suppress bottom line earnings per share, and companies really begin talking about the impact of that, that's going to be a different story altogether for the markets. Now, it's interesting in the Fed's Beige Book, every month the Federal Reserve comes out with what's called the Beige Book, and it's really kind of a survey of regional manufacturing. The word tariffs was repeated over and over and over again through that Beige Book announcement. In fact, it was one of the most prevalent topics through the entire Beige Book, which is concerns, not necessarily a direct impact yet, but concerns by manufacturers and producers of what tariffs would mean to them, whether it's higher steel prices, commodity prices, etc. So pay attention to that. It is important. Now, the good news for today is that we've continued this rally in the markets. If you're watching our live stream right now, you can catch us on at livestream.com or simply go to our Facebook page or subscribe at our YouTube channel, Lance Roberts Show. And you can subscribe and keep up with all of our videos right there online. But if you're watching our live stream right now, we talked about this yesterday. The markets really kind of bounced off this previous breakout high, which was extremely important because when we broke above the January highs, and this occurred back on August the 27th, the markets jumped up. We came down, retested that breakout level. See, that was very important because, see, that confirmed the breakout. The markets bounced off that support, and now we're retesting. We're really close to retesting the high that was set back in August. Now, that's if we break above that, that's going to be new all-time highs for the markets and should propel this market further up towards 3,000. And again, that's kind of our interim target right now for the markets between now and the end of the year. We could certainly go a little higher than that, but 3,000 is a big round number, and I think traders are really going to be focusing on trying to get the markets up to 3,000. It's just, again, it's kind of one of those big psychological round numbers. It's like, you know, Dow 25,000, Dow 26,000. Everybody gets hats and puts it on, and it's just a big round number. It doesn't mean anything. It's just simply one of those millennial marks. And so there's a real possibility here that traders are going to try to make that push. Now, when they do that, of course, that's going to be kind of exciting for the markets and things. But again, what it brings back into focus is simply the direction and trend of the overall market. And this is why we recommended increasing exposure after we came down and retouched that high and then bounced off of that, we said, okay, go ahead and add some exposure. We increased exposure in portfolios a bit this week as well, adding a few new positions to our portfolios. Of course, our portfolios have been pretty much fully allocated this entire run, but we had a little bit of cash available. We wanted to put that to work here because of this whole idea we may make a run to 3,000. I will tell you, though, there's a couple of areas that do elicit some concern right now that we're definitely paying attention to. One is taking a look at some of the leader companies in the markets. Amazon is a good example here. Despite the fact that the market's trying to reach here to new highs, Amazon is actually forming a declining trend in price. A break below about 1920 on Amazon is going to be a bigger trouble for the stock shorter term on a technical basis. Could definitely push the stock lower. So you definitely want to keep a watch on that. But more importantly, this was one of the main leaders that was driving the market higher as of earlier this year. It's part of one of the FANG stocks, right? Facebook, Amazon, Apple, Netflix, Google. That stock has not been leading while this market's going up. Speaking of Netflix, it's another good example. It's not been a leader either. In fact, if you take a look at a lot of the FANG stocks, in general, they have already shown signs of weakness and are no longer, this is Google, no longer leading the market. So when you lose your leaders in the markets, that's certainly telling you that there's something going on. We're having a rotation within the markets, and we want to watch this very carefully because these big major companies, Facebook, Amazon, Netflix, Google, etc., those previous leaders are no longer leading right now. Now, I shouldn't say that entirely because it's not exactly the case across the entire board. Apple is still continuing to lead. It's in a nice positive uptrend. It did have a correction as of late going into earnings, but after their announcements the other day, it is improving. Microsoft, on the other side of this, as also the same thing. So out of the FANG stocks, we still have two of the leaders still leading, but it's a much narrower charge in the markets currently. Furthermore, as we've talked about here recently, emerging markets continue to be a real drag overall. And again, when you take a look at what's happening with emerging markets and international stocks, the underperformance there is quite significant, which potentially suggests, and again, if we look around the global markets, right, we look at the Shanghai, we look at Japan, we look at a lot of the European countries, those markets are down 15, 20%. But yet we've got a U.S. market near all-time high. So again, it really suggests that the global economic environment isn't nearly as strong as what is we kind of currently believe in the markets, right? The U.S. economic data looks good, but all around the rest of the world, there's a good bit of deterioration going on. And again, it's possible that the U.S. can kind of remain an island in the storm, so to speak, for some time. But eventually that global economic weakness, if it doesn't pick back up, is going to start to weigh on the growth of the U.S. In fact, we're already seeing some early indications here in the U.S. Trucking demand is starting to drop a bit. We're seeing some other areas of the markets. Auto sales came out today, very weak in what's happening with the auto sales. Retail sales weaker than expected. Again, those are some of the early kind of warning signs we want to pay attention to. Production was up, but that was due to a huge surge in air conditioning. So there's a demand on some things that are utility-based that's also a drag on consumer spending. So again, this is why I'm saying we want to kind of pay attention to some of these internal factors that are currently going on in the markets. Also, too, we talked about some of the semiconductor stocks, KLA-Tencor as well as Micron. Also, previous good leaders of the markets have really broken down here as of late as well. So again, when we come back and look at the global markets, pay attention to your money. The markets overall continue to look fine. Again, I'm not really worried about much right now, but you definitely want to pay attention to what's happening in some of the sectors and pay attention to what the risk is in your overall portfolio. If you've got any questions, be sure and get by the website, realinvestmentadvice.com. Send me an email. Always happy to help you out any way that I can. But again, just pay attention to the global risk. Our newsletter will be out tomorrow. We're talking about some of these very same things, about the trend of the market, and also why this market looks a whole lot more like 1998 than it does 2015, and there's a lot of similarities there. So that'll be out in the morning, so make sure you're subscribed at the website, realinvestmentadvice.com. Be right back after the break, and I'm going to talk a little bit about Robert Shiller today, talking about why this bull market could last a whole lot longer than you currently expect. Don't go away. That's coming up next right here on the Lance Roberts Show at realinvestmentadvice.com.
The Lance Roberts Show is a production of Clarity Financial and Real Investment Advice. For past episodes, blog posts, and additional information, go to our webpage, realinvestmentadvice.com. Additional sponsors include the Witsit Vision Group, now with 3 locations in the Houston area, including Katy, Spring Branch, and the Woodlands. Dr. Jesse McKee has performed thousands of lens replacement procedures, including Lance Roberts and Brent Clanton's. See clearly. See Witsit Vision Group, witsitvision.com. And by Clarity Financial. Clarity Financial is dedicated to building, preserving, and protecting your wealth and guiding you to achieve your financial goals now and into the future with a holistic approach to financial life planning. Find out more or book an appointment today at myclarityfinancial.com. The Lance Roberts Show is recorded before a live internet audience in the Clarity Financial Studios, deep within the energy corridor of Houston, Texas. Look for our podcasts on iTunes, Spotify, Stitcher, and wherever better podcasts are found. You can watch today's video clips on our YouTube channel for The Lance Roberts Show.